the bear market comes when the predominant belief of the previous bull market is falsified.
Welcome back to Breakout with Breaking Views. I'm Peter Farlarsson, the global editor of Breaking Views in London's Canary Wharf, and I'm joined once again by Edward Chancellor in the West Country of England. Eddie, good to see you again. Welcome back.
And nice to see you again, Peter.
Eddie, it's been a while since we last spoke, and a lot has happened in that period. We've had central banks around the world raising interest rates rapidly, trying to keep up with inflation, ructions in markets, a sort of mini meltdown in the UK government bond market with pension fund problems and so forth. Some of this sort of tying into things that you've been writing about for a long time, about the sort of the hidden risks that were building up in the financial system. Just put this into context for us a bit in terms of what you think is going on.
So, Peter, and I've written this in the column, my argument is that every bull market, great bull market, is driven by a dominant idea. Think of the dot-com bubble, a belief that internet traffic was doubling every couple of months, or the US real estate bubble, with the belief that US property prices nationwide could never decline. The bear market comes when the predominant belief of the previous bull market is falsified. And that, I mean, I also cite the case of the Eurozone debt crisis, because if you remember, up to 2009, there was a belief that sovereign debt in Europe had been banished, and then suddenly the Greek problems appeared, and then everyone became aware of this sovereign credit risk in Europe. Now, what to my mind is happening now is that over the previous 10 years, there was an assumption built into both market behavior and market structure, but also into real economic activity, that interest rates would remain permanently low. What the central bankers, if you remember, up until only a couple of years ago, were saying lower for longer. Then inflation came along, and they've started to tighten, as you say, and now all hell's breaking loose, and we're trying to make sense of it.
Yeah, well, you have this great phrase about the sort of the monetary policy gets into all the cracks, and so that the sort of that idea of low interest rates has spread everywhere.
Yes, or that interest is, as Irving Fisher, the great economist, said, an omnipresent phenomenon. So interest gave us the everything bubble, and now the low interest gave us the everything bubble, and now low interest is going away, then everything is also at risk. I mean, I saw a piece even this week saying, are vintage cars no longer an investment? I mean, vintage cars are one of the sort of silly, sort of bubble-rich luxury assets that were meant to be an alternative to investing in the stocks. And I see. So the way in my piece, I break this down into Donald Rumsfeld's categories of risk. You have the known knowns, and I would say, the fact that the stocks have gone down, the fact that bonds have gone down globally, the fact that real estate markets around the world are teetering, and in the case of Australia, have actually sort of gone down quite significantly. These are, so to speak, the known knowns, type of stuff, as I've been writing about for years. And then there are the unknown knowns, things that a few people know but are not generally understood, and these are pretty important. Say, for instance, the known unknown of the global financial crisis was simply this: that if US house prices ceased rising, they didn't have to fall, then subprime mortgage securitizations were at risk. So that was the little known unknown of that. So what we had now, and this is, to my mind, extremely significant event, was the ructions last week in the gilt markets.
Yeah.
Now, people ostensibly blame that on a new conservative government coming in with an unfunded spending plans. Okay, so that might have been the trigger, the camel that yes, the sort of straw that broke the camel's back. But the underlying problem, as you know, is that the British pension funds seeking to hedge their long-dated liabilities had entered into interest rate swaps in long-dated gilts at very, very low yields. Now, the reasoning behind this was that if interest rates fell, they would lose money on those long-dated interest rate swaps, but on the other hand, their liabilities would decline. So typical modern finance, it looked like a win-win. And then,
but as we've discovered, they were leveraging up their positions, right?
Yeah. I mean, according to reports, they were levered up to 7 times, and you know, these funds had, you know, total footings of a sort of £1.5 trillion. So they're the whales of the UK financial markets.
Okay, but that's a sort of, I mean, it's a problem for the UK, and it's obviously the Bank of England had to intervene, and there are consequences. But just sort of stepping back a bit from the UK, what does that tell us about what might be going on or what might happen elsewhere? How do you look at that in a broader context?
So the way I see it, as I mentioned in the piece, is this reminds me of the problems that the Bear Stearns hedge funds had announced in the summer of 2007. These were invested in mortgage-backed securities. And when those problems emerged, it told you that subprime was going to be a problem. To my mind, what this shows you is the extraordinary fragility of the financial system to even very small rises in interest rates. Bear in mind, the Bank of England bank rate is only 2.25% compared to its post-war average of 6%. So it's roughly a third of its post-war average, and already the gilts market is collapsing. And then so as I say, the unknown unknowns is how this $600-800 trillion derivatives market that has really built up in the last 40 years of falling interest rates, how that can hold together if we've just seen these interest rate swaps being the first sign of problems to come. Now, that for me is an unknown because, you know, I'm not a great specialist on the derivatives market, but you know, you speak to people who are, and they don't know either. So
yes. And I suspect this is something that we may all have to become more expert on over the coming weeks and months. Anyway, we're going to leave it there. Fascinating as ever. I'm sure we will return to the repercussions of this and sort of forward-looking consequences in future discussions. So thanks very much, and talk to you soon.